I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's show is Toby Rodes, the co-founder and managing partner of Kaname Capital, a value and quality-oriented manager of small-cap Japanese equities. Our conversation covers the case for Japan and why this time is different. We discuss Toby's deep-rooted fascination with Japan, his education in Japanese culture, and transition to investing on the sell side and at GMO. We then turn to the past false starts of Japanese activism, recent changes in corporate governance, and Kaname's process to take advantage of the opportunity. Lastly, we touch on value traps, the carry trade, and the potential for private equity activity in a new era of Japanese corporate stewardship. Before we get going, in recent Spread the Words, I've introduced our newest Capital Allocators University for investor relations and business development professionals. It's a 2-day event, December 3rd and 4th in New York City, where we'll help you learn how allocators think, prepare to put your best foot forward, optimize your experience at conferences, and learn what not to do from a panel of CIOs. I think our CIU for IR and BD is unique in the industry. At least I'm not aware of another opportunity to level up your professional capability alongside a group of your peers. We're excited to put this together for you and help bridge the knowledge gap between you and the allocators you seek to serve. You can learn more and sign up to attend at capitalallocators.com/university. Hope to see you there. Please enjoy my conversation with Toby Rodes. Toby, great to see you.
Great to be here.
Why don't you take me back to what got you interested in Japan?
Well, it was my grandfather. My grandfather, an industrialist in Cincinnati, was invited to Japan in the late 60s to help rebuild the Japanese glass and steel industries. He made high-temperature industrial bricks, and there were only 2 companies in the world that could produce bricks that could go to 1,400 degrees. And with that, he made the 4-day trip to Japan in 1968. And after that, he would go almost every other year and pass through Washington, D.C., where I grew up, and tell me stories about the other side of the world. And being a white guy from the Midwest, he made Japan seem very interesting to me by making up interesting stories about how it was polite to burp at the dinner table. He was a gardener. He was a self-made engineer, and he found many levels at which he communicated with Japanese people well beyond the language. So that made a strong impression on me. Ultimately, it's been a lifelong constructive obsession. My entire professional career has been thinking about Japan.
What was your path to start engaging in it?
The irony is that I bounced off of Japan twice before I got there, meaning I was supposed to go in high school. I shattered my kneecap on the soccer field and couldn't go. I read Hedrick Smith's book, The Russians, and I got very interested in Russia and tried studying Russian, and the Russian teacher begged me to stop. And that's when I learned that Russian is poetry and Japanese is math, and that I've got a faculty and facility for both math and Japanese. So I'm very grateful for those 2 bouncing off of Japan initially and allowing me to go deep the 3rd time in.
What was that 3rd time?
3rd time in was graduating from Haverford College, going to Washington, D.C., and starting out at the Brookings Institution. My first boss was a visiting scholar from Japan, Jiro Tamura from Keio University. This is 1990, 1991. To cast back, Japan had reinvented capitalism. Washington, D.C. was wondering what could be learned from Japan. By being Professor Tamura's ghostwriter, our message was, frankly, nothing. That Japan and its 1989, 1990 equity bubble was really the first emerging market bubble. That was our argument. You had a mispriced currency and poorly sterilized Forex reserves pouring into that economy, and no one wanted to hear it. That's when I realized that Japan was both interesting, that there was a lot of reasons that that bubble existed in front of the world's eyes, and people gave Japan credit for it rather than calling it what it was. I realized just how inefficient markets were. It's taken 30 years for the Nikkei to get back to that level.
How did you go from working in policy to getting involved in the markets?
Professor Tamura was telling me very clearly that I was mastering an interesting policy area, that unless I layered Japanese and familiarity with the culture and the way things work in Japan, it ultimately would be interesting, but not really a career. And with that, I was very lucky to get a 2 years, all expenses paid scholarship from the Rotary Foundation to study first the language and then to study law in Japan in Japanese. That's when things really went into high gear. I got off the plane in 1993 with a Cannondale bicycle, a small amount of clothes, and a strong sense of adventure, completely committed myself to studying the language.
What did you learn from being there on the ground about the culture as it impacted your lens of what you saw as capitalism from the time of the Brookings Institute?
Great question. Japan seems immediately familiar when you touch ground. There's Kentucky Fried Chicken, there's McDonald's, there's pizza, but the pizza comes with corn and squid on it. The Big Mac is the third best-selling product in Japan behind the teriyaki burger. So it seems familiar, but in fact, as you get to know it, all of a sudden you're really surprised at how different things actually are. I'll fast forward and tell you when I really figured out how Japan is different is with this legal background. I was hired by a U.S. law firm and brought back to the U.S., where I was the back office of the U.S. trade representative in a big trade dispute, Kodak versus Fujifilm. What was at stake was figuring out why Kodak couldn't reach the Japanese consumer. How had Fujifilm created a sanctuary market? The answer was through very complex distribution schemes, coordination with suppliers. They made it very clear that only Japanese products were going to reach Japanese consumers. I deeply studied this event because Kodak had been operating and missing this market for years, and I needed to show what was happening. So it took me way back into the 60s and 70s, my grandfather's era, and I saw just the collaboration between the corporate entity and the government and how they were collaborating to thwart foreign capital and foreign product entry into Japan. That's when I realized that Japanese capitalism is fundamentally different. It is designed for insiders. It is designed to benchmark domestic products against foreign products, figure out how to keep foreign products out, how to keep foreign capital out, how to keep things uniquely Japanese, and compete intensely in third markets outside of Japan. It's a very unique developmental capitalism. And with that, I realized that I accidentally learned the tools for understanding how Japanese markets work. I took that knowledge eventually to being a sell-side equity analyst.
There's a curious part of that where you're understanding how this is an insider's game as you're on the ground. I wouldn't think that would necessarily lend itself to, oh, we're going to invest in these companies as an outsider. What was that thought process as you became a sell-side analyst?
I realized how markets were organized in Japan so you could figure out who the winners were going to be. Winners are chosen in Japan, that competition is managed. I had the good fortune of starting my career in the telecom sector. What made that sector different is at the time I started, there were really only 4 companies. An international company, KDD, a domestic company, NTT, their recently spun out cellular business, Docomo, and a third new market entrant that was introduced to finally mix up and create competition. And in this, the rules of competition were very familiar to me, and I understood how this market would be organized. And it made it very easy for me to model and be helpful to foreign investors thinking about allocating capital to Japan.
What did you see that you didn't anticipate in those years as a sell-side analyst?
The fact that the domestic investing complex in Japan, whether it was the pension funds or even their own trust banks, they knew everything about, for example, Docomo when it was listed in 1998. They knew how many base stations there were. They knew the age of everyone on the board. They had no idea how to value a growth company. They had never thought about what free cash flow was. Believe it or not, in 1998, I was the first published discounted free cash flow model. Despite being a foreigner and having passable but not perfect Japanese at the time, I had 300 meetings with the entire domestic investing public. And the reason was they all wanted my floppy disk of a discounted cash flow model. They were being told that they should value Docomo on 11 times earnings and a 2% dividend yield. This is when a light bulb went off for me that my job is to figure out what Japan needs and figure out how to bring that into Japan and be a bridge and arbitrage those skills. So that has served me well for 30 years, always figuring out what Japan can't really quite see around the corner and bring that into Japan.
In those first bunch of years where you were on the sell side, what were some of those other insights that you found and were able to share?
I believe in 5-year cycles, and my career in Japan has at first been figure out the language, figure out how to basically be engaging and make friends and just become part of the group. It's a group tribal society. So you have to figure out how to get inside. So that first 5 years was spending time and being part of the KO rowing team and living in the rowing dorm and learning how to become bilingual, bicultural, and code switch, learning how to be Japanese, if you will. And then when I transitioned to the professional career, what I learned is that they didn't understand valuation largely in the market and that I was able to provide that. My next bridge too far was when I thought, well, people really want my opinion. The role of an investment bank, especially a research analyst, is to tell people when to buy and sell. I tried to write sell notes. And that's when I learned that the role of research in Japan is to be a cheerleader, nothing more, nothing less. That people didn't want your opinion, they wanted stocks to go up. I started writing sell notes, drafts of them, and those drafts would make it on the desks of certain powerful people. And I'd be told that if you really valued your opinion, you might think about moving to the buy side. Ultimately, that was a great career move. And that was the end of my sell side experience.
As you transitioned over to the buy side, what was that experience like in those years at GMO?
GMO was a great first point of departure from the sell side. The person who turned out to be my mentor was a big buyer of the Docomo IPO. And when I called him back in 2002 and I told him it was time to sell Docomo, and he said, this has been the longest job interview. It's been 4.5 years, but you told me what to buy and then you told me when to sell it. No one else has done that coming out of Japan. Would you consider coming to work at GMO? I started there ultimately in 2005 and was dedicated to the Japan product and learned a lot of good habits at GMO.
What were some of those good habits you learned?
Independent thinking, complete ownership of your idea from start to finish, no committees. Everything from sourcing your own ideas, leveraging quant, but not relying upon quant, managing the prices where you wanted to buy, literally being the trader of your stock. So you owned every piece of the outcome of your sleeve in the portfolio.
What led to your transition to finding Kaname?
So I told you about my 5-year cycles, and I've been through 3 of them at GMO. Learn how to put together a portfolio. Learn how to think about that in the context of macro events. Finally, learn how to take a portfolio that I'd inherited that had ultimately 77 stocks and turn that into a high conviction portfolio of just 13 names. How to really take constructive risk. And when I mastered those 3 5-year cycles, I saw on the horizon that Japan was finally waking up from a 30-year slumber, that a governance breeze was blowing, and that true to form, what Japan didn't understand and that I could arbitrage into this market was accountability and governance. But Kaname Capital was really the distillation of everything I'd learned at GMO and why I wanted to purpose build a company specifically to go after a part of the Japanese market that was largely misunderstood, neglected, too cheap for a value manager to ignore.
So before diving into how you're doing that, I'd love to bridge that with talking about the case for Japan today. How do you put this opportunity set today in the context of what you've seen over your career?
We drive Honda cars. Your neighbor has a Toyota. Your kids play on a Nintendo Wii. We grew up on Game Boys. The service on JAL is the best service you can possibly get on an airplane. The product focus in Japan is tremendous. It's a rich country. It's a high trust culture. All these things that intrigued my grandfather are still true. but the capital markets are still woefully under-optimized. The case for Japan is quite simple. The US has gone through tremendous financialization and financial optimization over the last 30 years. We've seen the private equity story play out in the US, where the story was quite simple. High-quality businesses, largely middle-cap companies, bought on very low multiples, deliver superior returns. Well, I submit to you today that that biggest pool of high-quality businesses on low multiples, great entry points, exists in Japan in the middle markets. It's basically a U.S. private equity playbook that exists for weird quirks of how the Japanese financial system evolved, but exists in domestic public markets.
So the corporate governance reform story has come in and out of favor in Japan, at least for the last 20 years. And I'd love you to take me through what didn't work in the past and why might that work this time around.
I like to preface the governance conversation as a proximate cause, but the ultimate cause in Japan is the cost of equity and the equity risk premium. Up until 2005, to buy Japanese equities was really a fool's errand. Multiples were high. The bubble was still deflating. Ultimately, it wasn't until the final banking crisis and the cleanup in 2003 and 2005 that the overall market derated. And that's the first time you heard talk of governance. It was because for the first time, management teams were under pressure to deliver on the cost of equity. So the first time happened in 2005 as Japan was finally emerging from a 2-decade-long period of overvaluation and a workout of the Japanese banking system. 20% of Japan's GDP was run through the Japanese banking system between 1997 and 2003. And they did that without a revolution. You could only do that in Japan. So the first governance phase happened in 2005 when the equity risk premium exerted itself. But another thing was happening at the same time. And that is that the Nikkei and Topix was on 7,000. Today, we've gone back to just under 40,000. The Nikkei and Topix was on its knees. The reason for that was that the Japanese pension complex was undergoing a change. What happened is corporate entities that were ceded the overall pension obligation were putting these obligations back to the government, and they had to do it through the market. So you had this huge forced selling as a mark-to-market needed to be established as a big pool of assets was handed back to the government. It was a huge air pocket, a downdraft. So while people were talking about governance, at the same time, this is when the first wave of activists showed up and realized just how cheap it was. But Japan was on its knees and it was undergoing an asset shift. The wrong people were showing up and saying, please, I have a flight to catch to New York. My suitcase is empty. Fill it with the gold. I need to catch the next flight. And I mean no disrespect to the first wave of activists. They saw the value, but they created a reaction in Japan which said, we hear what you're saying, activists, but the time is not right. We're on our knees for the wrong reasons right now. So out of this came a spate of poison pills, and Japan circled the wagons and shut down governance reform to basically prevent the looting and the asset stripping of a Japan that was finding itself undervalued at a very weak point in its recovery from the previous last 2 decades.
So that initial wave that didn't really work out also sounds very consistent with how you described the culture of Japan, the ownership of companies, and capitalism for the insiders. Why has that shifted since then to make this a more attractive period of time?
Because it doesn't work. Japan finally understands that this system and its 3 lost decades is proof that capital doesn't flow from low return ideas to high return ideas in Japan. That this system was engineered to keep foreign capital out, to keep foreign competition out. It worked to the extent that you were a catch-up economy. But once you'd caught up, there was nowhere for the system to go except hold Japan back.
How do you know, looking at companies and assessing the market, that the insiders have decided that it doesn't work?
You get invited into the control room. And I didn't know it at the time, but at GMO, I did probably 450 meetings in Boston a year in Japanese. And the reason the carpet was worn out to our meeting room was GMO had both my fundamental portfolio and then a quant team that owned anywhere from 125 names. So every Japanese company that saw GMO show up in their shareholder roll thought I was their shareholder. I made it a policy. If someone wants to come and talk to me for an hour about their business, I would say yes. And out of this came a relationship with the C-suite of the top 700 companies in Japan. What I didn't know at the time is the quiet person that shepherds the C-suite into my meeting room are from the trust banks. And the trust banks are quietly taking notes on who is engaging with Japanese companies and always asking them to make a better peanut butter and jelly sandwich, but doing it in a way that's constructive. I didn't realize that I was building a track record and a following in Japan. With great humility, what happened is a lot of these stewards of the companies, primarily from Sumitomo Mitsui Trust Bank, ended up becoming the insiders in the GPIF, the Government Pension Investment Fund in Japan. These guys were the drivers of the governance upgrade in Japan. I told you that the cost of equity and the equity risk premium is a big ultimate mover of the Japanese equity market. It's GPIF that needs equities to perform to deliver on their pension obligations. So they realized that all of these complex relationships and conflicts in the Japanese financial services market meant that only outsiders could come and constructively cut some of these threads and free up the flow of capital in Japan. I got the signal when GPIF knocked on my door and said, "We don't do this for many people." I'm speaking with, again, great humility. They said, usually it takes a year for people to get a permit to operate and run funds in Japan. We think we can accelerate that for you. That was one of a few catalysts for spinning out of GMO. But that's when I realized just how serious people were about bringing a different type of viewpoint. And as I'd done in the past, bringing an accountability and a governance framework that Japan didn't really speak. It was a language they didn't really understand. But they realized that there were several people that could help transplant some of those concepts. And I feel very fortunate to have been chosen as one of those people to foment for change in Japan.
What's happened over the last 7 years, and particularly recently, that has you particularly excited that we're on the cusp of a significant change in governance?
So there's another false start that happened in 2012, 2013, the Abenomics push. I'd be remiss to skip over that. It was another false dawn. That was the BOJ doing a hostile takeover of the Japanese bond market. They drove the final push on the JGB yield curve, dragging it through zero. When I was at Brookings, we debated whether Japan could go through zero, and boy, did it go through zero. What that meant is GPIF was flushed out of the JGB market and was pushed into the equity market. It was thought that just by making debt super cheap for Japanese managers, they would access the semi-permanent capital, bonds, and the story would write itself. Animal spirits would be unleashed. It didn't happen. It didn't happen because the voices of shareholders were still too muted to drive that balance sheet reflation of replacing high-cost equity with cheaper debt. So that was a failure. So fast forward to 2019, 2020, where thankfully Kaname Capital has been invited into the study groups at MITI, into the study groups at the FSA. And they say, how can we finally get the voice of minority interest shareholders to change the capital makeup of the balance sheet? And we said it's a market for control. Without a market for control, everything is fine words without fine deeds. Until a management team suffers an unsolicited bid from someone who will run the assets better, you won't get the type of change you're looking for. Japan is always looking for the bloodless, painless revolution. It doesn't exist. If you want the rain that waters your crops, you got to have thunder and lightning too. I took MITI officials to Harvard Law School, and they met with the leaders of activism and the importance of takeover bids in a properly functioning equity market. That's when I literally saw the light bulb go off when the participants from Japan said, "You mean there's no such thing as a friendly takeover?" And the team from Harvard said very convincingly, "Of course not." That's when new language came out of the MITI guidelines for a word that hadn't existed before in Japan: unsolicited takeover bid. Up until then, everything was a hostile bid. But they recognized that there was social utility in a market for control. This is what's playing out And I'll put some data to this. Today, there are 4,000 listed companies in the US. The US got to 4,000 listed companies from 8,000. Over 20 years, the brutal aspects of American capitalism meant that there were a fair amount of management teams that either sold, lost in takeover bids, handed off their assets to somebody who could manage them better. In Japan, we had the same 4,000 listed companies, but we got there from 2,000. That over the last same 20 years, we've added a lot of people during a period of a negative equity risk premium that were told that they could be a listed company with no strings attached. This is the case for Japan. You've got tremendous product focus, and we're on year 3 of a cost of equity seeping into all parts of this equity market. And I would say over the next 10 years, 1,000 of the 4,000 listed companies are likely to be exited in one way or another. This is pure value creation.
How does the culture shift to attach strings for being a public company?
What's really interesting is Japan has tried to educate their own domestic investor complex to be better custodians of capital. And they look to the UK, a kinder and gentler market than the US, and they saw the UK Stewardship Code. They latched upon this shortly following the rise of Prime Minister Abe, who said, we need to have at least one independent director in all Japanese companies. That was a revolution in 2013. And out came the Stewardship Code from the FSA. And this code was trying to teach the language to domestic investors that it's not a taboo to ask for higher return, higher dividends, better balance sheets. It took 10 years for this conversation to take form. I've got a lot of theories around that, but my strongest assertion here is that no one was rewarded for taking that risk. It was really the emergence of the foreign manager with strong research capabilities, largely backed by U.S. university endowments, that led the ultimate upgrade and the transmission of the Stewardship Code into reality. And what we found is where a lot of these outside firms have pushed, domestic institutions are following. So this is why this time is different. We're seeing very constructive voting finally coming from the domestic investing complex. It's transformational.
How does the regulatory body or regulatory bodies go about some type of enforcement of the Stewardship Code?
Japan is different. They make domestic investors disclose how they're voting. They embarrass them. It takes MITI to embarrass the managers of these companies. They have to threaten unsolicited takeover bids. It takes the TSE to literally publish a list of companies that are not publishing a cost of capital and proof that the management team is managing the business with a cost of capital mindset. So there is no immediate one center to this. It is a collaboration between various parts. And you'd think that it would be the investors that grab this bull and take it by the horns, but they wait until all the other institutional stakeholders and participants and regulators give them the green light before they take action.
So I'd love to turn to how you were taking advantage of this. So let's start with Kaname. The name, what does it mean?
So Kaname is the linchpin. It's the linchpin in a fan. So a fan in Japan is the symbol of prosperity. And the more the fan is opened, the more prosperity is being shared. And this is a well understood symbol in Japan. And by being the kaname, the pin, the whalebone that literally holds this fan together, our role is to protect the cost of equity. We think the cost of equity is the kaname of the economy. With the proper protection of the cost of equity central to every balance sheet, you get capital to start flowing again. So this message is the reason we think in our dialogue and our engagement with companies comes with a high degree of spreading prosperity, joint value creation.
How do you think about what works in generating returns?
Value works, but you have to be very careful. Value works for two reasons. One, in Japan, this has been a growth-starved economy for a long time. When there is a growth company, it tends to get overvalued. Traditionally, the boundaries of growth are hit and the company disappoints. So value works because you start with low expectations and any positive surprise is asymmetric return. The other thing about Japan is it's easier for me to love what the herd hates, that I find it easy to embrace and understand why the collective wisdom of the market in Japan is often wrong, because they do not understand when leadership is embarking upon a journey of change. When I first started investing in Hitachi, one of Japan's large cap darlings, it was 2008. The share price was 236 yen. A new manager came in and sat in front of me, Nakanishi-san, and he said, I've read through the notes. You've kindly met with Hitachi for 5 years, and every year you've given us a laundry list of things we need to do. I've read it. I'm here to tell you that we have failed. Our share price is back to 1973 levels. I'm going to do what you've told us to do. The meeting lasted 30 minutes. And in that 30 minutes, I realized that this company was serious about change. We backstopped a follow-on offering, and the stock has been on a tear for the last 12, 13 years. Japanese people laughed at me. They were horrified. So it's very easy to find huge, long-run, secular stories that Japanese people are very late to understanding.
How do you avoid value traps?
It's the biggest risk in Japan. There's no shortage of cheapness. By most counts, still half of listed Japan trades at less than 1 time price to book. It's hard to argue with what that means. Our analysis of a market where half trades less than 1 time price to book means half of the listed market is still defaulting on their cost of equity. So how do you find the diamonds in that rock pile? We do it with a quant screen because by our analysis, still roughly 60-70% of listed Japan, roughly 3,000 companies, remain totally uncovered by the street. Our quant screen is based upon 3 primary quality factors. One is to reduce the risk of high fixed cost businesses. We want companies that can keep margins high through now a 15-year look back. The second is probably the most important, and we call it management rate of return. What we're doing is we're adjusting the asset side of the balance sheet, and we're only looking at assets used to produce a sale. You're looking at the muscle of the balance sheet, and you're forgiving the fat. Let's face it, Japanese balance sheets still carry a lot of fat. But because of that fat, the muscle can get ignored, and we focus on the muscle and we turn it into an adjusted ROA by taking operating profits after tax, and then we hold it to a 10, 15-year look back of generating consistent 10% adjusted ROA. You don't do that by accident. You have to have very productive assets to be able to do that. The last thing we do is look at incremental returns on CapEx. Here, we're using a longitudinal study that shows not only good management, but operating in a good industry. So once we've meshed these 3 attributes of quality, we know that this company has tremendous product focus and they operate in a good industry. And by and large, they've got certainly better than average management. Then we just ask that we're able to get those stocks on less than 5.5 times EBITDA. And lo and behold, there's still 300 of these companies in Japan.
When you've run those screens and you've got your shopping list of 300, how do you think about confirming that what you saw in the numbers is something that will translate to a business that is going through change?
That's where the quant turns into fundamental work. The middle step is we take those 300 names and rank order them by a pretty naive but punitive DCF. So with that, we organize our research, and on any given quarter, we're visiting 30 or 40 new companies. Our first meeting is literally for the first 45 minutes to say, we are here because we think you're a high quality business. And we spend the first 40 minutes confirming that our numbers are right. And 9 times out of 10, the numbers don't lie. This is a high quality business. And then we finish in that first meeting and we say, but you're too cheap. Here's where it gets really interesting. The person on the other side of the table might say, yeah, I know that. But the old man in the corner, he lived through the bubble. He had a highly levered balance sheet. And he said, never again. Can you help us tell the story of why balance sheets matter and why we should be using cheaper capital against higher quality assets? That's where we find kindred spirits and partnership, and we're a solution for these sorts of companies. The other example, and this is hard-earned and maybe a trade secret that I'm willing to share, is the person smiles politely and says, I know we're a listed company, but we're not really a listed company. Being listed and managing it with cash on the balance sheet is our way of handing the company off to the next generation. And if we can do that at 0.6 price to book, we save 40 cents on the dollar in terms of the inheritance tax. You can bang on the door, you can kick, you can scream, but our shareholder structure is such that you're not going to really change us. So we're a porcupine. Do you really want a quill in your nose? Maybe you should go somewhere else. So you have to be very careful about being dazzled by cheapness.
When you're assessing management's willingness to improve the stock price through those meetings, and you've got these two extreme buckets of, yes, please help us, and go away, how much does the understanding of the local culture help you interpret what that message is?
It's hard work, and even Japanese people miss it at times. It's not an overstatement to say that sometimes not even Japanese people know what Japanese people are saying. And sometimes my job is to pretend I don't understand what they're saying. This is the dynamic, and I'll walk you through a few examples. We hear a company that understands that they've got a good business. It's not a run and hide, try and dodge taxes type of business, but maybe they're a slow-moving company in a slow-moving industry, and they've just never really thought about shareholder return. They've got a big anchor shareholder that owns 35%, a negative control element, and they know that basically they don't have to listen to shareholders, so they've gotten in the bad habit of not doing it. This type of company has, in the process of ignoring shareholders, has also ignored animal spirits and aggression. And when we show up, we say, do you realize that there's a shift happening in your industry? You've got 25% global market share. Now is the time for aggression. It might sound strange to you, but we're not here to ask you for a big buyback and a large dividend. We want you to go all in on investing in next generation fuels in your Himeji plant. We want you to capture market share in ammonia, methanol, hydrogen, next generation fuels in the shipping industry. We've never thought about that, says the company. We wait until our customers tell us they're ready for what we're ready to ship. We've got all the technology, but we're a supplier. They said, this is the moment where you drive the change. This has taken 2 or 3 years, but this type of partnership has allowed us to put people on the board of this company. This company flies and spends 7 hours with us in Boston and whiteboards around what new service offerings, how to reposition themselves, how to re-articulate their equity story to the market. They finally realized the power of the equity market. So that's the positive. The negative is the same negative controlling shareholder role, but we find a fact pattern of self-dealing or bad behavior of insiders, a complete failure of the board. And I want to be clear, we do go in hard on some of these companies. We exercise all of our rights as shareholders. We bring shareholder proposals. We bring derivative lawsuits against the board in cases of obvious self-dealing. And what we find is that these two strands of our strategy are complementary, that in both instances we're principle-based, that we're looking for properly functioning boards to deliver companies composed of the highest return assets with the lowest cost of capital. And when we're in the public, driving good companies to be better because they've got insiders that are trapping value, that helps us with our story and credibility with companies that realize that we can partner with them to drive change, that no matter what, we're looking for the best outcome for the company.
When you're going to construct your portfolio, adding names in on the margin, how do you assess the trade-off between valuation and your ability to engage with the management team to help them drive operational improvements?
First and foremost, we're a value fund. That's the discipline that I was taught at GMO, and we continue it to this day. By adding those quality elements to our screen, we think we've given ourselves a huge head start by avoiding those value traps. These companies are not value traps from an operational and product standpoint, but for various quirks, they might be trapping value. So the first step is we always try and figure out the degrees of freedom of management. If we're going to ask for something, can these guys actually deliver it? Is there some hidden constraint that we don't know about? Have we done enough research to really understand what's holding these guys back? This is the cultural element again. Because Japan is a proof of work culture, they won't tell you, hi, here's the pressure point. This is why I can't do it. You got to find it. This might harken back to my time working as the back office of the U.S. trade representative, but I was locked in a windowless room reading Japanese documents for 2 years. I love reading Japanese documents. The great thing about Japanese documents is they're very comprehensive. People accuse Japanese companies of having awful disclosure, and it's true. It's awful disclosure in English. It's great disclosure if you read Japanese. And we find all of our fact patterns and points of engagement in public information.
How do you decide how many companies to own in the portfolio?
That's been an evolutionary step. And one confession is in our 5-year existence, we started as an equally weighted value portfolio and thought that the factor would drive the return. And in our mind, where quality meets value, Japan has shown that it compounds at about 12%. In the first year or two, the best companies in our portfolio with open shareholder roles got bought. We enjoyed the market for control expressing itself in our portfolio, and 5 companies got bids. And we thought, hurrah, we've bottled lightning. What we didn't realize is that the remainder of our portfolio were the tough walnuts. The easy nuts had been cracked. So through that, we had to parse and let go of the nuts that we could never crack, and then find the ones that we could. And then we had to refresh using our output to find higher and better uses of capital. That was a lesson learned in 2021, 2022 through COVID. And thankfully, I was able to bring this highly talented team on from Japan. A key addition was Nao Makino. I found him at Columbia Business School. Young, hard-charging veteran of markets at a young age of 33. And between us, we jokingly call ourselves Batman and Robin. He helps me understand the fact pattern I see and translate that culturally into conviction. So today, our portfolio is really 15 names, with the top 5 or 6 names representing 50% of our portfolio. That's where our engagement has led us to events where we know through the mosaic that action is on the horizon. So we think our conviction is really uniquely informed and uniquely positioned.
When you talk about cheap, if you look at summary valuation metrics of your portfolio, what does that look like today?
So I told you 5 of our top names are 50% of our portfolio. We're still, with 50% of our weight, sub 4 times EBITDA, about 3.5 times EBITDA, 9 times earnings, 3% dividend yield. Market multiples in Japan are 7, 8, maybe depending on where you look, and maybe market cap adjust, 12 times EBITDA. So we're anywhere from a half to a third of market multiples. Our free cash flow yield is 40, 50% higher than the market. Our ROEs are 30, 40% higher. So we are twice as nice, if not more, at half the price.
How do you think about holding periods?
Engagements take time. The conviction that we enjoy today, that 50% in 5 names, is the product of 3-4 years of very hard work. Conviction is a 3 or 4 year process. So holding periods are anywhere from 5 to 7 years. And I'm going to throw a bit of a curveball in that one of our main really headlines for why this time is different in Japan is there is a market for control. And we feel in certain of our lead engagements, there are sufficient trust elements to our relationship where bringing capital to privatize the company is not out of the question. We're starting to see this, that the public market investor, through the duration of that investment and through doing the hard work of partnering with management, has developed the credibility to make the case for privatizing the company. And that's something that we would like to explore. So when you talk about holding periods, well, infinite might be one answer.
How do you think about sell discipline?
So our buy discipline is hard-coded. If it doesn't pass our screen, we're not looking at it. But our sell discipline is much more deep, diligence-based. What do we really think this company is worth? And then we add a layer to that and we say, what do we think private equity is willing to pay for it? We're trying to put a premium for control in our valuation. So our valuations and holding periods tend to be both longer and reasonably aggressive. We are the first stage of unlocking that value in giving management confidence to understand that better ownership equals better outcomes for employees, for all stakeholders, and that what used to be considered hostility is now maybe a better way of delivering on the function of a company.
If your conviction that now is the time doesn't play out and you look back a pre-mortem over the next 5 years, what are some of the risks you see of what could cause this to not work?
So the big element here, and it's playing out, is that this market for control is too painful for Japan to bear. Let's be clear, there's a tit for tat going on. Nippon Steel is showing up and trying to buy US Steel. The flip side is a Canadian peer of one of Japan's giants, Seven & I. If you've been to Japan and you've been to a 7-Eleven in Japan, you know it's a fundamentally different company than a 7-Eleven in the US. It's a tremendous service offering. And the Canadian entity issued what is quote unquote a friendly bid for what is a almost sacred part of Japanese life. We're already starting to see Seven & I turn to the government and say, aren't we national security? Shouldn't we be able to thwart a aggressive takeover bid? We're all watching this closely. And the answer is Seven & I has had run-ins with Third Point. It's had run-ins with Value Act. And now it's got a run-in with someone who's not just a financial operator, but an operator of convenience stores saying we can run them better. We see this as constructive and positive. We don't think that Japan is going to run and hide, but watch this. This is where the thesis is playing out and where the friction point is. I would suggest that where we're operating, though, still offers another path, and that the average size of our companies are distinctly middle market, and nothing that we're bidding on or areas we're operating on is quote unquote essential and would fall under the national champion need for protection. And just as imagine someone showing up and trying to bid for Boeing, or someone trying to bid for another national champion in any other market, these things are complicated. Japan isn't going to offer everything up for sale. But the bad capital allocators, the companies that have defaulted on their cost of equity, we're being told that that's game on.
How does the rise in interest rates, cost of debt, and increased cost of equity affect the outcomes of these businesses?
The second risk is a stronger yen. The yen is obviously the first derivative of interest rate differentials. And perhaps we'll talk about the carry trade and some of the convulsions we've seen recently. Our portfolio is built for these events. What I mean by that is the yen carry trade and the yen strengthening is something we're prepared for. We don't have a portfolio predicated solely upon weak yen. We think that risk is primarily high valuation. In almost any environment, whether it's strong yen, weak yen, slow economy, higher interest rates, we've incorporated all that history in our screen and our 10-year look back, and all of our companies have survived all of these exogenous shocks. So our portfolio is built for even things like the normalization of Japanese interest rates. We think it's positive because what it does is it finally puts a price tag on the cost of debt, and it means that what was being offered for free, you're now going to have to pay for. And anytime you put a price tag on decision making, people start to act. So we think that rising interest rates in Japan is just the sign of the Japanese economy finally normalizing.
How do Japanese companies and the markets respond to something like the yen carry trade and the noise around it?
So it's a challenge. The yen in 2023, and I think I'm quoting this right, went from 107 yen to 161 yen to the dollar. How do you manage forecasts in a world where your currency is moving that aggressively? And what does that mean? It means Japanese companies have been very conservative on thinking about the positive impulse from the weak yen. It used to be the weaker the yen, the better. When the yen went through 140, Japanese companies started saying, this is not good for us anymore. So they've already been signaling that they don't want the yen to go to 160. So they're prepared for even our round tripping back to the 140s where we are today.
So last year we had a positive move in stocks. As you look out, when does the banging the table of this is an exciting time to be investing in Japan get normalized?
I have been thinking about Japan a long time, and only last year did I make the fateful decision to say this time is different. First time in my career that I've really felt that this time is different. The bang the table is you start seeing funds getting the green light to play defense against bad governance in a way we've never been enabled. If the company just gets too cheap, we can bid for it. What speaks to bang the table more than that? We no longer have to beg, cajole, and hope. We just show up with capital and buy. Up until this market for control, the market really wasn't functioning. Japan was a museum. You could come, you could look, you could examine, you could read about, you could be interested in, but you couldn't buy anything. So you were at the whim of the museum. And often closing time meant you had to go home. But now this transition to a market means if you want it and they're not responding, you can buy it. That's a pound the table moment. When the capital that is piled up in private equity finally feels like they can actually make bids for companies, get financing, get the support of the share transfer agents, there have been so many informal blockages to these bids, but tick by tick, all these blockages are getting removed. Kaname Capital today can make a bid for a company and expect every part of the unsolicited bid chain from investment bank, share transfer agent, Japanese bank, and lender to provide financing services to get it done. This is different.
Toby, I want to make sure I get a chance to ask you a couple of fun closing questions before we wrap up. What's your favorite hobby or activity outside of work and family?
Offshore sailing. It's a passion. It's simple to explain. When you're offshore and you're on day 2, you've managed to get 4 hours of sleep every day, and you're handing off navigation and trimming and sailing at night to another team of people. You create a really high trust team. You work really hard. It's an adventure, and your world becomes incredibly small. It's 11 people in the space of 40 feet. You're a little quirk, and you can see other people that you're competing against. But when you get to your destination, you get into that harbor sometimes at 3 a.m. It's a feeling of elation that's hard to describe.
What's one fact that most people don't know about you?
I love Air Jordan 5 shoes. I wore them for the first time in 1991. And something about connecting with Michael Jordan through those shoes, I'm a sucker for it. Nothing creates more startup impromptu conversations than being anywhere and somebody coming up and saying, wow, nice shoes. I've even had someone at O'Hare Airport offer to buy the shoes off my feet. These are my pride and joy.
What's your biggest pet peeve?
People that waste time. Ben Franklin famously said that life is just composed of moments in time, and anyone who's wasting your time is wasting your life. And I remember reading Ben Franklin in college and thinking, I promise to do as little harm to others and their time, and I hope to have that favor returned to me.
Which 2 people have had the biggest impact on your professional life?
I first have to say my wife. And the answer there is coming home from a day at work, she looked at me and said, did you have one of those days? And I said, I had one of those days. And she said, do you really think it's time for you to do something on your own? I said, it's time. She said, you should do it. And I'm giving you 18 months to do it. If you're going to do this, I want you to give it your all. I want you to have an end point. And I don't want it to always be around the corner. So she put a time horizon on my ambition, and I had to show results. That's a really important partnership that helps bring great clarity to something as hard as starting your own company. I think the second is a mentor in Japan, Wakabayashi-san. Wakabayashi-san is a titan intellectually, an engineer. When I first got to Japan, almost as a stowaway, found my way into an investment bank, I was the only foreigner in the investment floor, the research group. And nobody thought a foreigner could bring any informational advantage in the Japanese equity market. And I was seated purposefully by the head of research next to Wakabayashi-san, who was the axe on Japanese semiconductor stocks, famous for 3 days of being awake and getting information. He was truly a titan of the brokerage industry, informationally, intellectually. That's when I realized, oh my God, that's my pace car. That's the person that if I can prove to him that I can be helpful and valuable, then I've proven something to myself and to this entire company. It took 6 weeks. He saw me grinding away on the Docomo IPO and being a downstream beneficiary, given his sector coverage. At 2:30 in the morning, he came over and said, so what's the semiconductor content of a base station? And is this going to drive semiconductor demand? It's the first time he'd ever asked for a data point. And that's the foundation of a relationship that today I cherish and gave me the confidence that I could push through some of those cultural barriers that seemed daunting at the time. That was the first test that I passed and probably the most important.
What's the best advice you've ever received?
I won't say who told me this, but it was 3 pieces of advice. The first was never work in a cost center. The second was never join a company that's just merged. The third was do your taxes, because if you do your taxes, you'll vote. I'm pleased to say that I've broken the first two, and that worked really well for me. But to this day, I still do my taxes.
All right, Toby, last one. What life lesson have you learned that you wish you knew a lot earlier in life?
I learned it, but I didn't know that I learned it. I learned to ride a bicycle when my mother put me on top of a grassy hill and just pushed me down the hill. And it was one of those bicycles where the rear wheel is connected directly to the pedals. So as I was going down this hill, the pedals started spinning faster and faster, and I had to take my feet off the pedals. At the bottom of the hill was a parking lot, and the parking lot had those cement bumpers. So all of a sudden I realized I had an 8-inch gap that I had to shoot. The lesson I learned was it's okay to be marginally in control as long as you have confidence that you can shoot the gap.
That's great. Toby, thanks so much for sharing this really compelling case for what's going on in Japan.
Enjoyed it. Thanks very much.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.